Methods of measurement of national income. There are three methods of measuring national income. The first one is output method, the second one is income method, and the third one is expenditure method. Output method. This method of measuring national income is also known as product method or inventory method. This method approaches national income from the output side. According to this method, the economy is divided into different sectors such as agriculture, mining, manufacturing, small enterprises, commerce, transport, communication, and other services. The output or product method is followed either by valuing all the final goods and services produced during a year at their market price or by adding up all the values at each higher stage of production until these products are turned into final products. Precautions to be taken while using product method of measuring national income are as follows. Point number 1. Avoid double counting. To avoid double counting, only the value of final goods and services must be taken into account while calculating national income. Point number 2. Guesswork. Goods used for self-consumption by farmers or manufacturers should be estimated by a guesswork. Imputed value of goods produced for self-consumption is included in national income. Point number 3. Deduction of income tax. Indirect tax included in the market price are to be deducted, and subsidies given by the government to a certain product should be added for accurate estimation of national income. Point number 4. Fluctuation in price level. While evaluating output, changes in the price level between different years must be taken into account. Point number 5. Depreciation. Depreciation of capital assets should be deducted. Point number 6. Second-hand goods should be ignored. Sale and purchase of second-hand goods should be ignored as it is not a part of current production. Income method. Income method of measuring national income is also known as factor cost method. This method approaches national income from the distribution side. This method can be explained with the help of the following points. According to this method, the income payments received by all citizens of a country in a given year are added up. The data pertaining to income are obtained from income tax returns, reports, books of accounts, as well as estimates from small income. In this method, the incomes accrued to land, labor, capital, and entrepreneur in the form of rents, wages, interest, and profits are all added up together. The sum of factor income is treated as gross national product. However, in this method, the income received in the form of transfer payments is ignored. India, the National Income Committee of Central Statistical Organization uses the income method for adding up the income arising from trade, transport, professional and liberal arts, public administration and domestic services. GNP according to income method is calculated as follows. NI is equal to rent plus wages plus interest plus profit plus mixed income plus net income from abroad. The precautions to be taken while using income method of measuring national income are as follows. Point number 1. Transfer income or payments. Transfer incomes or transfer payments like scholarships, gifts, donation, charity, old age pensions, unemployment allowances, etc. should be excluded from the measurement of national income. Point number 2. Income from sale. Any income from sale of second-hand goods like car, house, etc. should be ignored. Point number 3. Ignorance. Income from sale of shares and bonds should be ignored as they do not add up anything to the real national income. Point number 4. Revenue should be ignored. Revenue received by the government through direct taxes should be ignored as it is the only transfer of income. Point number 5. Undistributed profits. Undistributed profits of companies, income from government property and profits from public enterprises such as water supply should be included. Point number 6. Imputed value of production. Imputed value of production kept for self-consumption and imputed rent of owner-occupied houses should be included. Expenditure method. Expenditure method of national income is also known as outlay method. According to this method, national income is calculated by summing up all consumption expenditure and investment made by all individuals, firms as well as government of a country during a year. Thus, gross national product is found by using the following formula. Ni is equal to C plus I plus G plus X minus M plus R minus P. The expenditure method can be explained with the help of following points. Point number 1. Private final consumption expenditure. Private final consumption expenditure by households may be on non-durable goods such as food which are used immediately or on durable goods such as car, computer, television set, washing machine which are generally used for a long period of time, or on services such as transport services, etc. Point number 2. Gross domestic private investment expenditure. It refers to expenditure made by private businesses on replacement, renewals, and new investments. National income takes into account the gross domestic private investment expenditure. Point number 3. Government's final consumption and investment expenditure. Government's final consumption expenditure refers to the expenditure incurred by government on various administrative services like law and order, defense, education, etc. National income takes into account the government's final consumption expenditure and investment expenditure. Point number 4. Net foreign investment or net exports. It refers to the difference between exports and imports of a country during a period of 1 year. National income takes into account the value of net exports. Point number 5. Net receipts. It refers to the difference between expenditure incurred by foreigners in the country and expenditure incurred abroad by residents. National income takes into account value of net receipts. The precautions to be taken while using expenditure method of measuring national income are as follows. Point number 1. Avoid double counting. To avoid double counting, expenditure on all intermediate goods and services should be ignored while calculating national income. Point number 2. Repurchase. Expenditure on the repurchase of second-hand goods should be ignored as it is not incurred on currently produced goods. Point number 3. Transfer payments. Expenditure on transfer or transfer payments like scholarships, old age pensions, unemployment allowances, etc. should be ignored. Point number 4. The expenditure repurchase of financial asset. Expenditure on repurchase of financial assets such as shares, bonds, debentures, etc. should be included as such transactions do not add to the flow of goods and services. Point number 5. Indirect taxes. Indirect taxes should be deducted from the calculation of national income. Point number 6. Subsidies. Subsidies should be included while measuring national income.